Okay, good evening, ladies and gentlemen. Welcome to the Wise Investment Seminar. It's great to see so many of you here. Some familiar faces and some people I haven't met yet, so I'll hope to meet you for a drink afterwards. Do stick around for some food and a drink. The last one of these seminars we had in this barn, I was reflecting, was about 18 months ago, and that was just before the referendum. And I was being reminded by one of our clients what we all said then. It's given us something to talk about anyway, so you should hear some interesting views as we go through the presentations. I'm Ben Peters, for those of you who don't know me, and I act as the Wise Group Chief Executive. And my slight title change since the last time I stood up here gives you a hint that we've done a little bit of reorganising within Wise to reflect the business as it's developed over time. And it's my job to make sure all the different bits of the business work together, work sensibly, and so on. And we've given each part of Wise Group, as it's now known, a divisional head, if you will. So Alex Ray, who will speak just after me, is looking after Wise Investment, so that's the part of the business that you will directly interact with. Tony Yarra, who most of you will know as the founder of Wise Investment back in 1992, is looking after the Wise Funds part of the business, and a lot of you will be invested in the Wise Funds, and is focusing on that. And he's been recently joined by Vincent Ropers, who is helping Tony with the management of those funds, and will also help him with the management of that part of the business as well. Amanda Sullivan is looking after all things financial and group services, so all the stuff that makes us able to do our jobs for you, so HR and accounting and so on. And I look after specifically the even load part of the business, and we manage the even load income fund, which again, many of you will be invested in. So that has enabled us to give due focus to all parts of the business and continue sort of delivering our services to you. But Wise Investment is all about you, our clients, and today you're going to hear about some of the investment and personal finance and planning matters that are hopefully relevant to you. So that's all I'm going to say, but I'll be looking forward to seeing the presentations and look forward to seeing you afterwards. Alex, thank you.
Thank you, Ben. Some of you will probably know me already because I've been at Wise quite a long time, and I may have been your advisor in the past as well. I've worked at Wise Investment for 17 years in nearly all of the areas of the business in various roles. When I started, there were 6 of us back in 2000. There are now quite a few more. And when I started, it was just Tony as an advisor, and we've now got a team of 5 advisors who look after you day to day. And when Tony set the business up in his basement 25 years ago, his ambition was to provide clients with the kind of service he would like himself if he was a client. We have got bigger, as you see, both in terms of clients and staff. But our focus has always been, and it will always be, on providing a personal long-term service to our clients. And that's something I feel very strongly about. And in my new role as Chief Executive, that's something I'll continue focusing on to make sure that that's something that everyone that works in Wise Investment really feels and is passionate about. At the last seminar, I talked about employee ownership, and we've now been employee-owned for 4 years. And I think for you as clients, it's actually really beneficial that we have become employee-owned. We run the business ourselves. We don't have any external shareholders to answer to, or external shareholders who wants to maximise our profits rather than looking at service. And we value the employee ownership really highly, everyone at Wise Investment. And it does ensure that we have a long-term home for the business and for our clients, even after Tony at some point retires. He's the founder of the business. We do try our best, but we may not always get it right. So if there is anything you'd like to talk to me about, please feel free to give me a call, or any of your advisors or anyone in administration, anyone that you know at Wise Investment, please get in touch. And if there's something in particular that you like, that you want us to continue doing as we grow, then please let us know as well, so that we can make sure that that's something we continue. We are 25 years old next month, so we wanted to celebrate it here today with you and say thank you to Tony. I can't see Tony, he's here. So it's a bit of a celebration as well, our 25th anniversary. There'll be some birthday cakes for you all to take home later. And hopefully we'll be here for another 25 as well. There'll be a Q&A at the end of the session, so please save your questions, and we'll try and have a long 30-minute Q&A session, so they should be able to answer all your questions. We'll also all be around afterwards, so please come and speak to us, and all the speakers will be around. In your bags there are some little feedback cards, and we'd be really grateful if you can either hand them in at the end, or there's some prepaid envelopes, so send them back. We are keen to carry on with the seminars, but your input is very valued. You may notice we're filming the presentations as well, but that's just the presenters, so don't worry, we're not filming the audience. And now I'm going to hand over to Robert, who's an investment advisor at Wise Investment. Thank you.
Thank you, Alex. This evening, I'm going to begin with a statement, which is that, generally speaking, as investors, we've experienced certainly above average returns from our investments. And that's partly understandable because prior to the recovery in equity markets in March 2009, equities suffered substantial drops in value. So one could naturally expect things to rise substantially out of that. However, that recovery, that sustained recovery for the last 8-9 years, has begun to run steadily ahead of underlying fundamentals like earnings or inflation or economic growth. And the key factor that has maintained that performance has been low interest rates. Certainly one of the main key factors has been low interest rates. And the question we ask ourselves when we're discussing investments within the business is, what's going to happen as and when that support is removed? What's going to happen to those traditional types of investments that we've been using in your portfolios, such as equities, bonds and property, if that support is no longer there? So this evening I'm going to cover two areas. The first is to look at our investment service and some of the areas of that service and some of the evolutions of that service that we're bringing into it. And secondly, to cover our investment outlook, especially trying to answer that question about what do we do with the investment landscape as we see it. As you know, as introduced, I'm Robert Blinkhorn, so I'm the investment manager. I work very closely with the financial planners in terms of developing asset allocation and selecting the investments. I cannot take credit for much of the performance as I joined in July. A lot of that performance goes to James Payne, who's been doing an admirable job wearing two hats. But now I become accountable going forward. So starting with slide 1, I want to begin with the top left-hand segment as you're looking at the chart. Our entire investment service begins with financial planning. So it's a key part of what we do is to understand you as an individual in terms of your objectives, goals, time horizon, attitude to risk, and a wealth of different bits of information that make up a unique person. And once we have that information, we can then use that to take the building blocks of our investment management service to create something that's appropriate for you. Going clockwise, within our investment service, it's sort of a multifaceted service. We have many risk profiles, many distinct expected risk and return portfolios and strategies for our clients. Clearly, we also look to generate income from those strategies, because income can be a very important part of a total return from your money. In addition to that, there are different ways in which we will interact with your portfolio on a regular basis. We have one set of services that will be very responsive to changes in the investment landscape, and rather tactical. However, they will not consider any tax consequences in terms of implementing those decisions. Clearly, tax consequences can be important to some people, or indeed, where those portfolios don't quite meet particular needs, we can then create specific portfolios that are bespoke and tailored exactly to you as an investor. In addition, we'll be looking to add to our investment services areas such as ethical strategies for clients who wish to have that theme running through their investment portfolios. Moving round, Wise is making a huge investment currently into its investment management service in terms of both technology and personnel. I'm an example of that, a part of that investment, and we will continue to make that investment. And the reason for doing that is that as we grow, it's imperative that we're as operationally as efficient as possible, so that we can continue to deliver and indeed improve the service that we give you, our clients. Within our business or businesses, there still remains the same intellectual capital, and that's a really useful resource for me. I will spend time talking with Ben and Hugh, Vincent, James, Tony, in terms of bouncing ideas off them and either tempering things where that view isn't shared, or indeed strengthening views in the portfolios where we reach some kind of consensus. So moving to the last segment, all of this work really results in us putting together a portfolio for you. That is really it really distills our best ideas in terms of asset allocation and fund selection, or investment selection, I should say. One overarching theme that in addition to looking for value for our clients in terms of investments, we need to make sure the portfolios are diversified. And diversification is a critical component of managing risk within your portfolios. And it's important to us that we get you from A to B as smoothly as we possibly can. So going full circle, we're back to financial planning. Again, it is a circular process. We're evolving. Our investors are evolving. The world around us evolves. And therefore, it's, again, very important that we constantly review with you what you're doing and the appropriateness of what you're doing and whether we can improve it in any way. So that covers our investment service. I'd now like to speak a little bit about an investment outlook. As I mentioned at the start, it is becoming quite challenging to justify values levels in markets, but that's not to say there isn't pockets of value out there. And just to roll through the main asset classes that we invest your money into, within equities, markets do look quite expensive in general. There are certain sectors that look attractive, such as possibly mining or utilities, or regions such as Asia or an emerging markets, and we can use those things, but we certainly can't put substantial amounts of people's portfolios into those areas, again, on the principles of diversification. Within fixed interest, bonds, probably going to give low returns. I'm not of the view that we're going to lose money, substantial amounts of money from bonds over a short period of time, but there is no denying the fact that interest rates where they are means that there are huge challenges in terms of rising interest rates going forward, and it was highly unlikely we're going to see the same return from bonds over the next 40 years that we've seen over the last 40 years, because there just isn't the level of interest rate contraction to produce those returns. And in property, again, a very mixed picture, but yields are very low in property because of people chasing income. There are certain areas that benefited from Brexit, say the areas focused on tourism. But there are other areas, such as city offices, which are clearly in a lot of trouble should things, negotiations and discussions not go particularly well, as they don't appear to be. Now, within our meetings, it's important to stress that we are focusing more and more, the conversations, I think it's fair to say, are focusing more and more on capital preservation rather than appreciation. And the challenge for us is to really find out how we best achieve that. We could put money into cash, but cash doesn't earn you anything. It actually loses money in real terms. So it's really a suboptimal strategy for our clients while we're waiting for an event that has no date stamp on it. And so I think the solution lies in using alternative strategies where the return from those strategies is not dependent upon the future direction of markets, and indeed is much more dependent on identifying a good investment and identifying a bad investment and possibly making money from both those decisions, assuming you get them correct. But in terms of complexity, there is a whole spectrum of complexity in these areas, and our focus is very much to keep it at the very simple, easy to understand end of that spectrum of alternative strategies. So, to summarise, it is our primary objective to create portfolios for you which meet your requirements. There is a wealth of resource that we are adding to within our business to achieve that. Financial planning is a cycle, and therefore one needs to constantly review and update and make sure that what we are doing is working. Value in markets is a rare commodity, but that does not mean that we just give up on the challenge of finding value. We just cast our net that much wider. And lastly, I would say, I'll leave you with a message, is that we will keep it simple and diversified. Thank you.
Good evening, everyone. So, for those of you that don't know me, I'm Hugh, and I launched the Even Load Income Fund at Wise quite a long time ago now, in 2009, so almost exactly 8 years ago, with my co-fund manager, Ben Peters. And the Even Load Income Fund is a kind of old-fashioned dividend growth fund. So the key objective of the fund is to deliver a growing dividend stream to our shareholders over the long term. And the way that we look to do that is to invest in the shares of high quality and predominantly British companies, which we think will be able to deliver that growth for us over the long term. Now, my talk today is called 4 Key Themes from the Business World. So we have had the interim results season over the last few weeks. So we've had updates from most of the companies within the portfolio, and we've been very busy analysing those results, talking to company management teams, and I thought it would be interesting to perhaps try and give a bit of a flavour of what it feels like to be a company in today's world and some of the trends that we're seeing across different sectors. So, theme 1. Low economic growth, low inflation, and low interest rates. So it hasn't been a disastrous time economically since the financial crisis, but it's certainly true that trend growth rates have been lower than perhaps you saw in the sort of decades leading up to the financial crisis. And I think it's also true to say that companies generally have struggled to grow at perhaps the rates in terms of sales and profit growth that they perhaps enjoyed before the financial crisis. And that sort of growth rates haven't been that volatile, they've just been a bit low. But that combined with low inflation has meant that interest rates, as Robert mentioned, have been at very low levels. And I've used this slide in a seminar presentation before, which is the Bank of England base rate going back to the late 17th century when the bank was formed. And as you can see, interest rates are currently at all-time lows. Now, why is it that we're in this environment? Well, I think there's some quite interesting structural trends that have created this environment, and I've sort of crudely generalised and called them the 3 Ds here. So debt, demographics, and disruption. And I think the first 2 there, debt and demographics, are very much to do with the reduced propensity of participants in the global economy to want to spend money. High levels of debt in the world still, just as high really as they were in the financial crisis, and that's reduced spending for consumers but also for corporates and for governments. Demographics, we are all getting older, I'm afraid to say, particularly in the developed world. The baby boomer generation is retiring. It's finding that life expectancy is increasing, and the pot of savings that people have needs to be stretched over a longer period of time, but also in a low interest rate environment. And then finally, disruption, so technological disruption. There's always innovation and technology in the economy, but I think it's been particularly interesting, the rate of development over the last few years, particularly in areas like software, like data analytics, machine learning. You've seen the rise of some very successful internet-based business models over the last few years, so businesses like Google, Amazon, Uber, Airbnb, and they've had some quite disruptive impacts on existing industry structures, and they've also really pressed down on the inflation rate over the last few years, and are likely to continue to. Just think about the effect of Amazon on prices in many product categories. So I think those structural trends are unlikely to dissipate over the short to medium term, and we're certainly finding that all corporations are being affected by them. Now, I don't want to sound, that probably sounds a bit negative, and actually I think there's actually some quite interesting opportunities that the current environment's creating. And just to address that point on technological change, we are seeing a lot of companies are really driving to improve efficiency and productivity and harnessing a lot of new technology to do that. And I actually think that's, when done well, a very positive trend, and it's probably the most ubiquitous trend that we're seeing across sectors at the moment. So everywhere we look, we're seeing upgraded IT infrastructure, better data analytics being used, more rational supply chains, more rational manufacturing facilities, and that can really improve a business's operations. Less mistakes can be made because management information is better. Companies can waste less stuff as well. Products can improve, customers can be happier, and obviously it can improve financial results as well. We're also seeing quite a lot of businesses in the even load portfolio are benefiting from selling products and services to other companies which help them improve their productivity. So here's a couple of examples. So Sage sell accounting software to small and medium-sized businesses, and they are migrating many of these small businesses from the sort of old-fashioned pen and paper bookkeeping or spreadsheets to real-time accounting, and with great effect, and are benefiting from that trend, that structural growth trend. Spectris, an example from the engineering sector, a test and measurement company which helps customers like wind turbine operators monitor their facilities, and they can help maximise output, reduce costs, etc. So we're actually seeing some quite interesting pockets of growth in terms of these business-to-business companies that are selling to other companies to help them reduce costs and get more productive. But I'll just sort of bookend this theme with a bit of a caveat, really, which is that improving productivity, as I say, is generally a good thing, but you must beware of those companies that dress up long-term investment cuts as efficiency savings. And actually there's a big difference between improving productivity and just cutting back on it, if you like, the lifeblood of a business over the long term. So investing in research and development, investing in innovation, training staff, etc. We've had a lot of conversations with management teams of holdings in the fund over the last few years where we've very much emphasised that we very much support consistent long-term organic investment in the future, even though that does burden current financial results. And I think that's a really important point to make. So my third and fourth themes are both very much a sort of side effect of the low interest environment that we currently see. And theme 3 is takeovers, and there's definitely been an increase in takeover activity across the market over the last few years. Debt is widely available, and the cost of debt is clearly very low at the moment. So there is a temptation for businesses to acquire other companies. And we've seen some activity in the even load portfolio. So here's 3 examples which have holdings have been involved in this year. So Unilever, Kraft attempted to take over Unilever earlier in the year. The bid was actually unsuccessful in the end, but it would have been one of the largest takeovers in corporate history. Atkins, the engineering consultant, was acquired by a Canadian firm earlier in the year, and Aviva has just recently announced a reverse takeover from a French company called Schneider Software. Now, there's some positives in terms of takeover activity. Clearly, if you're a shareholder in the acquired company, it can benefit performance, and certainly in the case of Atkins and Aviva, both those businesses have been positive contributors to return. But I think, again, there's some caveats and negatives with takeover activity. The first one is it can be a great shame to lose great companies from the stock market. And I think the best example in recent years for me was when Kraft acquired the great British business Cadbury in 2010, and then effectively dismantled this great portfolio of brands and a culture that had really built up since the 19th century. And certainly from our perspective as Unilever shareholders, we were very pleased that that takeover attempt from Kraft didn't go through. The other perspective is, as a shareholder in an acquiring business, it can actually, if that business takes on a lot of debt and acquires a business at an expensive valuation, then that can put more risk into the business for long-term shareholders. And that takes me on to my last theme, which is rising levels of corporate borrowing. And this chart shows a ratio of debt to earnings in the UK market over the last 8 years, and also compares that to the same ratio for companies in the even load portfolio. And as you can see, British companies on average have borrowed a bit more over the last few years, and that's partly that businesses have used that debt to make acquisitions, but in some cases they've also borrowed money to return it to shareholders, whether that's as dividends and special dividends or as share buybacks. Now, that's fine when interest rates are low, but as Robert alluded to, at some point interest rates might go up, and clearly that is then a risk in terms of the interest costs moving up over time. And it's a risk factor that we're very conscious of managing in the even load portfolio. And if you look over the last 3 years particularly, that's really been a focus in terms of some of the portfolio changes that we've made. So that's all from me. I think really the message I'd like to leave you with is that it is quite sort of tough out there in the big wide world of the global economy. It's a difficult environment for savers. As Robert mentioned, there are plenty of uncertainties. However, and this is really not probably a message which has changed from me over the last few years, we do still see some very good opportunities to continue to invest in high quality businesses at what we think are attractive valuations, and where we can see very good potential for those businesses to grow both cash flows and dividends over the medium to long term. I think I'm now introducing my father, Tony Yarrow.
Hello. Thank you for coming. Can you hear me? Yes. Good. Okay, well, I'm Tony Yarrow. I find it hard to believe, but I've been managing investment funds for nearly 30 years. And for the last 25 years, I've been managing investment funds for Wise Investment. And when we launched the company in October 1992, we wasted no time at all in setting up investment funds. because we wanted to try and improve returns by active management for our clients rather than leaving them in funds which did the same thing year in and year out, having the possibility to go into cash if we needed to, if everything looked not very good. And what I'm going to do this evening is to just run you through the history of our managed funds. Now, so there we were. We'd set up these two funds, and I can remember the excitement that I felt the first day that we got a cheque made payable to Scottish Mutual, which is the first bit of money for the first fund, 23,500. It came to our house on a Saturday morning because we used to run the business from our house. And there was this money on the Saturday morning, which meant that I had a real live fund to run on the Monday. And I've been doing it ever since then. Now, the funds that we managed in those days, in the early days, were very different from what we're doing now. They were called closed broker funds, and they were run through insurance companies, and they were closed because you had a range of their funds to invest in. So we did it with Scottish Mutual, Clerical Medical, and Scottish Equitable. And the funds where they had an equity fund and a UK smaller companies fund and a European fund and a fixed interest fund and all the rest of it. And so my job from one day to the next was to allocate the money between these funds. And that was all right for a while until we realised that there was a fairly major drawback, which was that if Scottish Mutual's UK smaller companies fund was rubbish, which it frequently was, you could get the allocation right, you could get into the right sector, the market went up, but the fund didn't. So you didn't get any benefit, but there wasn't anything else to do. So finally in 2000, we made a move from closed broker funds to open broker funds, which were still with the insurance companies, but now we could invest in any investment trust or any unit trust that we wanted to. And that change is something that we've continued to do to this present day. It means that we had several thousand funds of which we could choose the best, rather than 10 funds of which we couldn't choose. We could only choose between the 10. So that was a change that we made in 2000. And that got rid of half the problem with the insurance companies. But the other problem was the insurance companies themselves. And they were an absolute nightmare to deal with. They used to open these funds, and then a few years later they decided to close them again, just when we got them up to a decent size. And then the other thing were they were insurance funds, so you couldn't put them in an ISA, you couldn't really put them in your SIP. So finally we decided, when we got enough money together in 2004, that we'd set up the OIC. And the OIC is the structure that we've maintained to the present day. And the OIC is a sort of umbrella under which the funds sit. And that also massively reduced the charges, which was a very good thing. And when we started, our administrator was Capita, and we went with Capita because pretty much everybody else went with Capita. And after a few years, we realised that Capita weren't terribly good. In fact, they were awful. So we had a sort of beauty parade, and we discovered a small company in Nottingham called T. Bailey, who had their own funds, which they managed which they administered in a very excellent way, and they were looking for clients. We were actually their first client exactly 10 years ago last weekend, and this has been a very good decision for us. It's been a very good partnership, and we've sort of grown together, and they're here this evening. So that's been very good. We made this one change of administrator, so when you see the TB in the funds, that stands for T. Bailey. So that was the next big change that we made in 2007. I'll skip over the great financial crisis because I'm sure you don't want to hear about that. And then I suppose the next thing that happened was in 2012, I'd been running the funds part-time for 20 years, and I used to go into work on a Sunday morning and sort of analyse the markets and decide what I was going to do. So I finally stopped being an advisor in 2012 and started managing the funds full-time. And of course, as soon as you do something full-time, you wonder how you ever manage to do it part-time. There's far more information, there are far more things to look at than you've got time to do it. So what we've actually done over the last few years is we've built up a team to run the funds and to take them forward. So I've slightly galloped through the history of the funds, and the reason why is because I think what's more interesting for everybody here is what's happening now and what's going to be happening for the next 25 years. So the first question is, over all this period of time, have we actually learnt anything? Have we got a process that's worth preserving or not? And so that's the question about, does the process work? Now you probably can't see those figures very well, but they're in your pack, and I'm sure you'll study them with great interest at your leisure, probably later on this evening. So I'll try and summarise it. This is a summary of the performance of Wise Income, which is the larger of the two funds I run since 2009. And we want to outperform this index, and we have actually since 2009 in 9 years. We've outperformed it in 8 years out of the 9, and in the year when we didn't, which was 2011, we only missed it by a small amount. And over that period, the annualised performance of the fund, which is to say if you'd reinvested the income and after charges, has been 18% per annum. That of the market has been 10.5% per annum. So either we have been extremely lucky over that period, which is possible, and indeed maybe the next few years will tell us how lucky we've been, or else possibly we have actually got a process that works. So I think that there is something that we want to sort of preserve and keep going and build on. And the next slide, here are our principles. Groucho, yes, go on then, you do it. While he's doing that, Groucho Marx once said, "These are our principles, and if you don't like them, we have others." But this is what we've evolved over the last 20 years or so, and I really just want to talk about one of them, which is the second one. I think most investors think investment is about one of three things. It's either about ideas, or it's about numbers, or it's about people. I've come to the conclusion that it's about people. I think good people make good numbers, bad people make bad numbers. When I'm talking about ideas, I'm talking about things like, I don't like President Trump, so I'm going to buy gold. I think Mr. Kim is an idiot, so I'm going to sell all my shares. Those sort of ideas we think are a very inefficient way of investing. I think the most efficient way to invest is to go out and look for people like us, who we like to think are professionals, who are doing what they're doing for the long term, people who they're either fund managers or they're company managers, but they've got that sense of integrity about them. They're busy people, they're hardworking people, but they're sort of sensible, and they don't do stupid things, they don't borrow too much money, they don't suddenly completely change the business around, take over a business that's 4 times the size or whatever. Those are the people that we're looking for, because we don't know what the future holds, but we do know that reasonable people tend to continue being reasonable. And if we can employ within our funds a lot of these people, then we think that the outcomes will be good in the future. They have been good in the past, as you've seen. That's what we're trying to do and to continue to do. Shall I stop there? Yes, I think I will do. Time's up. Right. Thank you. Sorry about the technology.
Hi. Tony and Hugh are always tough acts to follow, I can tell you, for whatever reason. If you don't know me, I'm Angus Aston. I'm the manager of the team of financial planners, or advisors, if you like. And I've been with Wise now for 13 years. And I'm going to pick up on a couple of the themes that we've heard, particularly from Hugh and Robert, about, I think Hugh mentioned demographics being a sort of key fundamental, and it being quite a difficult environment for savers. And I wanted to kind of illustrate that particular point, given that most of us in this room on average, not us, not me, but sort of approaching retirement or in retirement, and you've diligently squirreled away some money to kind of look after you in retirement, and we need to make sure that we do the best for you in terms of making it last. And this is one of the sort of the challenges that we face, and we hope we can answer through our investment process and our advice. But just to start with, it's worth looking at the background. In the old days, which is I'm classing as before my time, but anyway, you could make your own judgment. Most people would have secure pensions from work when they were retiring, sort of up until, I suppose, the mid-90s. There are still some around, and some of you receive them, I'm sure. Or you could, if you built up a pension fund through saving and investing, you could then turn it into a fairly generous, secure annuity. Those seem like something from the dim and distant past. And even failing that, you could keep your money in the bank and get a decent rate of interest. Of course, we now know, right now, that none of these things are true. And not unconnected is the point that Hugh made, is that on average we're living far longer than we used to. So I don't know if anyone wants to guess, if you're a healthy 65-year-old, oh, I've already pressed the button now, you don't have to guess, there you go. You can expect, I thought they was going to come up one at a time. Anyway, never mind. You could expect to be around for another 25 years or more, which I'm going to present as good news. And, of course, there'll be some of us who are around for much longer than that, and we need to plan for it. So the particular point I want to illustrate is that we now are all kind of investors for our lives, I think, and we need to deal with the volatility that markets present us with, whilst taking advantage of the opportunities. And the reason why this is so important, we think, is I'm going to sort of illustrate this with a couple of concepts that might be well known to some. One's pound cost averaging, and one's called reverse pound cost averaging, or pound cost ravaging, as it's been dubbed. So sort of to give you a bit of analysis, I've pieced together three different, in inverted commas, investments that over a 15-year period that happen to have produced the same overall return of around 120%. So if you put in £10,000 at the start, at the end it would be worth £22,000. And that's an average return of about 5.4% per year compounded up. But, as you'll see, they've got there by very different routes. So this is a bit of a fudge, because the blue one and the grey one are the UK stock market, but over a 15-year period, but different 15-year periods. And then the one in the middle, which I've just dubbed steady plodder, is the UK gilt market over 15 years. So in blue, we've got a good start and a bad end. So actually, that's the financial crisis right there. And the grey one is a bad start. Well, it looks like a good start for a year, and then really tails off in the 3 years from there. And then there's another downturn, and then there's recovery. So I'll call that a bad start, good end. And the point here is that if you're an investor, you're actually paying money into investments all the time. What you want of all these three options is the grey one, because you get to buy shares at cheap prices at the start, so you build up a lot of capital and get your benefits at the end. So to show this, there's over those three charts, this is the sum of money you end up with after 15 years in each of the three different routes. So if you make a bad start, you've got about £47,000 more on this model than if you make a good start. And as you'd imagine, the middle of the road one is in the middle. The challenge when you are in retirement and you're wanting to draw on this money is that it all goes into reverse. So if you think, right, I've built up a sum of £200,000 and I want £1,000 a month, which is about 6% of what you've got. to fund my lifestyle, extravagant. If you've made a good start, if the markets make a good start, you get good growth at the start, then even after 15 years, you've still got more than you started with, even drawing 12,000 a year. But if you have a bad start, just to go back, then you notice that you've drained a lot of your capital base in the early years by selling investments at low prices. And your money might never recover from it. I don't want you to alarm anyone here, but you're 15 years in and your pot's dwindled, then you might be around for at least another 12, as we're saying. So we need to do something about this. And we think there are various ways of dealing with this. An obvious one is to take less money out of the pot. So if you draw 4% instead of 6%, then even with very bad early years, you end up, your chin is above water after 15 years, and you've got a fair chance of that lasting you for the rest of your life. And of course, if you get good markets, then you're better off. You'll also notice, I hope, that the discrepancy between the best and worst is smaller at 55,000 when on the previous slide it was 87. So one strategy is not to weigh too heavily on your money, or not to expect too much of it. Sorry, that sounds wrong, but what else can you do? Well, what about the middle road? Why can't you just invest in something that produces you a decent overall return without any volatility? Well, that 15 years of gilts has produced 5.4% a year, but now if you buy 15-year gilt now, you can expect something like 1.4% a year, which is not going to do the job for you if you want a decent amount of income and you've got to contend with inflation. Well, that's a perpetual problem. Now, we've heard presentations on 2 investment funds that produce income, and that, I think, is actually a very good strategy. Can it produce enough income for you? That's one question. And also, you are always going to be looking for investments that pay income, and there are other investments that don't pay income that are perfectly good as well. So that's one factor to consider, and the other one is if you've got a pension fund, you have to take regular withdrawals. They don't just produce the dividends. So we've got to manage this in some way. So at the risk of labouring the point, you need to invest in more than one asset class. I would also say that, going back to that slide, those are the market, and we think that with sensible investment, as we've heard already, that we can actually do better than markets, probably with less volatility. We can't avoid volatility, but we can definitely try and reduce it. Whoops. As Robert said, you need to keep it under review. Things change, your circumstances change, the markets change, there may be other opportunities on offer, so we need to make sure that we're active in switching it around. And you need to be able to adapt. Sometimes you've just got to put up with difficult times and maybe adjust your expectations of income. But that's how we think we can crack it. And we hope that you'll trust us to continue doing that for the next 27 years, as it might be. That's all from me. Thank you very much. We have a guest speaker who is Jane Bedford from Knight Solicitors, who's going to tell us a bit about powers of attorney and wills and good estate planning. So I hope you'll find it very useful. Thank you.
Good evening, ladies and gentlemen. As Angus said, my name's Jane Bedford and I'm a solicitor at Knights in the private client team at Oxford. And I've been asked to come and talk to you about wills and LPAs. And the focus of the talk this evening is, if you've got a will and LPA in place, perhaps, are they up to date? So I'm not going to ask for a show of hands for who has a will in place, but there's just a reminder up here about why it is so important not only to have a will, but make sure it's still fit for purpose. So your will makes sure your estate is distributed in accordance with your wishes. A reminder that unmarried partners have no entitlement under the intestacy rules. The intestacy rules are what apply if you don't leave a will or your will doesn't fully dispose of your estate. You can choose the people that you want to administer your estate. These are your executors. You might have trustees if there is an ongoing trust, and I'm going to talk a bit about those roles in a bit. If you've got children under 18, you can appoint guardians. You can make sure you're dealing with your estate in a tax-efficient way. Mention leaving assets on trust. You can provide for disabled children, provide for any business interests you have, any agricultural property. And I've just put a note, if you can see it at the bottom, that jointly owned property isn't disposed of by will. So if you own joint assets, just bear in mind they do pass automatically to the surviving joint owner. So just a note about executors. These are people of your choice that are over 18. You might have made your wills 20 odd years ago before you had children or when your children were young. So do you want to update them and now have your children as your executors? As we said, they're responsible for administering your estate. Trustees administer any ongoing trust. Some people have different people, but most of the time it'll be the same. They have to act unanimously, so consider carefully who you're appointing because they have to work together. And consider replacements in the event that your chosen executors or trustees cannot act. Consider whether you want a professional. You can have a solicitor or an accountant, and there are circumstances that merit that, but bear in mind that they will charge for their time. You don't actually need to let your chosen executors or trustees know that they're appointed. And when the time comes, they don't actually have to take up the appointment. I've just picked out a few things that you want to consider in your will. We've mentioned guardians. Chattels, by that we mean your personal effects. We tend to put flexible clauses in our wills that allow you to dispose of items by a letter of wishes. So you don't have to change your will each time you want to change where certain items pass. Cash legacies, have you specified whether those are free of or subject to inheritance tax? Have you considered charitable legacies and have you identified the charity correctly? Are you going to include specific gifts of certain items, such as property, in your will, and have you included a substitute if you sell that property and purchase another one? And is there an ultimate default provision? If your family are in a common accident, are you thinking about a default clause in your will? And the last one, if you've got assets abroad, we've now got the EU succession regulation. So are you putting an election in your will about the law that is to apply to your foreign assets? Spouses will often have mirror wills, so the order of deaths doesn't matter. Your ultimate wishes will be the same. You might have a simple structure where you leave everything to your spouse and then to your children. But when we see clients, we talk to them about different options that you might want to consider and the benefits of those. And the two I'm going to mention today are the benefits of a life interest trust and also a discretionary trust set up in your wills. And when we're doing that process, we also consider the ownership of property. So we mentioned joint assets. If you're leaving part of property interest on trust, you want to consider being tenants in common rather than joint tenants. So life interest trusts are very common where there's a second marriage situation. So the deceased might want to be able to provide for the second spouse for their lifetime, but ultimately leave his estate to children of a first marriage, as an example. So the life tenant will often be the spouse. The life interest means they can live in the property, receive the income from the capital for their lifetime, but they're not entitled to receive that capital outright. There can be the flexibility to advance capital to them, which will be up to the trustees, and the life tenant can be one of those trustees. And on the life tenant's death, that capital then goes to what we call the remainder beneficiaries, which are predetermined. That life tenant can't change that. And I've given the example there of the second marriage, but there are other circumstances in which clients decide to use a life interest trust. It gives you certainty that your ultimate beneficiaries will inherit your estate. Obviously, if you leave assets outright to a spouse, they can change their will and leave it to the dog's home or wherever they want. And bear in mind, anything that goes to a spouse is exempt for inheritance tax, and a life interest trust is no different. The life tenant will... what passes to the life tenant is exempt for inheritance tax. On the life tenant's death, the value of the trust is aggregated with their estate for inheritance tax purposes. Mentioning now discretionary trusts, so these are as they sound. The trustees have complete discretion as to how they distribute capital and income. So there's a pool of potential beneficiaries, but nobody has an entitlement to receive anything. So ideally, you have a letter of wishes, and it's really flexible because you don't have to change your will. You keep changing a letter of wishes. You don't need us to do that. So as your circumstances change, keep your letter of wishes up to date. If you're setting up a discretionary trust in your will, it could be over the property, or it could be over all of your estate or part of it. It's taxed in the same way, but there are potential inheritance tax charges ongoing if the trust is continued. And income tax is also a consideration. Generally, the administration of a discretionary trust is a bit more onerous than with a life interest trust. What some of you might have in your wills, if you did them before 2007, is a discretionary trust being set up on the first death of the nil rate band amount. So this is the amount of £325,000 at the moment that you can leave free of inheritance tax. And before 2007, if a spouse left their estate to their surviving spouse, that was exempt from inheritance tax, and they effectively lost their nil rate band amount. Since 2007, that's changed. You can transfer unused nil rate band allowance between spouses. But it was very common before 2007 for these trusts to be included in your wills for that reason. A lot of clients come in and say, well, I don't need this anymore for inheritance tax purposes. I just want straightforward wills. And we have a conversation with them about the benefits that having these types of trusts in your wills do give you. So, for example, protecting them from being assessed for care fees. So clients are quite keen to ring fence and protect those assets to stop them being spent on care. And it also gives you another way to ring fence assets. For example, if a beneficiary is going through a divorce, any assets in the trust, rather than being paid out to them, they're protected in that way. Just mention business and agricultural assets. If you have any of these, it's even more important to look at your wills and your circumstances being up to date, what assets qualify for relief for inheritance tax purposes, and thinking rather than giving those to your spouse, on the first death, do you think about giving those to what we call chargeable beneficiaries, so children, for example, and in effect cashing in those reliefs rather than relying on them still applying on the second death? Relatively recent, we've had... if you give 10% of your net estate to charity, the amount passing to charity is exempt from inheritance tax. But what now happens is, as long as you leave 10%, the rest of your estate benefits from a reduced rate of inheritance tax at 36% instead of 40%, which is actually quite attractive. We do calculations for clients, and when they can see the difference, that you can give funds to a cause of your choice rather than to the tax man, it's often quite appealing for people. And there's a special clause we can insert in your wills if you want to take advantage of this. But we have to think about who bears the burden of inheritance tax on your residuary estate. Okay. This is quite topical. So in April of this year, just get to the right one. On the 6th of April, we had an additional nil rate band introduced. So as well as the 325,000 that everyone has, we've now got a residential nil rate band. So it starts at £100,000 per person, and it's if you pass a property down to direct descendants, essentially. The £100,000 goes up incrementally, so by 2020-2021 tax year, it'll be £175,000 per person. This is how they got to their £1 million nil rate band, because 2 times the 325 and 2 times the 175 is it's transferable between spouses in the same way. Direct descendant is interpreted broadly, includes stepchildren, adopted children, etc. But if you've got any will that leaves assets on trust, it might be worth checking that they would still qualify you for this extra relief. You don't have to have a specific clause in your will to deal with the property passing down to direct descendants, but we can have a look at it for you if you're not sure. There are a few different types, and I'm going to mention here enduring powers of attorney and lasting powers of attorney. So enduring powers of attorney were discontinued in 2007 and replaced by lasting powers. But if you made one before the 1st of October 2007 and it's executed validly, it can still be used. But we're finding a lot were not signed correctly. So do get yours out and have a look at it. We can have a look at it for you. And bear in mind that this does only cover property and financial affairs. It doesn't cover health and welfare. So when in 2007, when lasting powers were brought in, we've now got the 2 types to cover both areas. We've seen, as I said, we've seen lots that aren't valid. So have a look. Some husbands and wives have just appointed each other and nobody else, so it's useless after one of them dies. And joint appointments can be very problematic. If one of your attorneys is not able to act, then a joint appointment means that the document can't be used. With an enduring power, they are dealt with slightly differently. So if somebody starts to lose capacity, the document's then registered to allow your attorneys to act under it. Just mentioning lasting powers. So if you make a document now, this is what we've got. We've got lasting powers of attorney for property and finance. You can appoint up to 4 attorneys. You can appoint them in different ways. We always recommend a joint and several appointment, which means they've got independent authority to act. It's the most flexible. You can appoint replacements, and you can give direction in the document. But again, we are big fans of letters of wishes to put your wishes down. There's some very important wording if you have, or you're likely to have, any fund that has a discretionary level of management. There's particular wording you ought to put in your power of attorney to enable your attorneys to continue acting on your behalf with your fund managers on the same discretionary basis. This is quite topical. It's come up and it's been problematic with some clients in the past. So we've got agreed wording that we put in our documents now. You need a certificate provider. This is someone to say that you have capacity at the moment to sign the document. And they have to be, LPAs have to be registered with the Office of the Public Guardian to be valid. So we register ours straight away. They're put in a drawer. Hopefully you never have to be used, but they're in place, ready to go, because they take about 3 months to register. Health and welfare. So these documents give your attorneys the power to consent or refuse life-sustaining treatment on your behalf. They've come in really as a replacement for what you might have heard of living wills or advanced decisions, so that your attorneys can express your wishes on your behalf if you're not able to. I've just put their letter of wishes even more important with that one. And just a reminder, as my final slide, what would happen if you didn't have a power of attorney in place. Your assets become frozen, your next of kin have no automatic rights, so a deputyship application is required to the court. It can cost thousands and it takes a long time, and then your appointed deputy has ongoing reporting requirements to the court. do get out your will and your power of attorney and have a look at it. We can have a look at them for you. Think about drawing up a list of assets. We are happy doing joint meetings with Wise, so do let us know if that's of interest to you. There's some information at the back, some fact sheets, so feel free to take those away. And I've left some cards and my colleague Becky's cards as well, so please do take one on your way out. Thank you very much.